Okay, so you want to own a five-star hotel. Picture it for a second. A marble lobby stretching toward a chandelier the size of a small car. A doorman in white gloves pulling open a door for a guest stepping out of a black sedan. A penthouse suite that costs more per night than most people pay in rent for an entire month. Somewhere behind all of that, you imagine, money is just flowing in around the clock. That is the fantasy. Here is the reality. Some five-star hotels bring in more than $500 million a year in revenue, and other five-star hotels, ones charging over $1,000 a night, lose millions of dollars every single year, wearing the exact same gold leaf ceilings and the exact same white gloves. Same category, same glamour, completely opposite financial outcomes, and by the time we're done here, you're going to understand exactly why. Before we go any further, understand what you're actually buying into, because most people assume five-star means five-star decor, expensive linens, a spa with candles burning in the corner. That is not how the rating actually works. The major rating systems used across the industry evaluate hotels on hundreds of individual standards, and the overwhelming majority of that score has almost nothing to do with the building itself. It is about service, how fast the front desk moves, whether staff anticipate a need before a guest even voices it, how quickly room service arrives and how it's presented. The physical structure accounts for only a small slice of the actual rating. What that means in practice is that luxury isn't a fixed state you build once and walk away from. It's a live, continuous performance that never stops, not at 2 in the morning when 90% of the rooms sit empty and the lobby is silent. The staff-to-guest ratio in a five-star property runs between 1.5 and 3 employees for every single room, compared to roughly half an employee per room in a budget hotel. That is not a small gap. That is an entirely different cost structure sitting underneath the marble. Let's start with what it costs before a single guest ever checks in. Industry benchmarks put the median development cost for a true luxury hotel in the United States at well over $1 million per room. And in major gateway cities like New York, London, or San Francisco, that figure regularly crosses $2 million per room. Build a 200-room luxury hotel in Manhattan, and you are looking at a total development cost somewhere between $200 and $400 million before you have checked in a single person. That number breaks down in ways most people never expect. Land alone can eat up 10% of the total budget, sometimes far more in dense urban markets. Hard construction costs, the actual steel, concrete, and mechanical systems consume the largest single chunk. Furniture, fixtures, and equipment, the beds, the chandeliers, the kitchen line, the spa fittings, add another meaningful slice. And then there's design fees, pre-opening expenses, and a contingency reserve sitting on top of all of it to absorb the cost overruns that hit almost every major construction project at some point. Now think about how that gets paid for, because nobody is writing a $400 million check out of pocket. Most of it is borrowed, and in a high-interest rate environment, the cost of that borrowed money runs between 6 and 8% annually. On a $200 million loan, that's $12 to $16 million in pure interest payments every single year, before you've hired a housekeeper, before you've turned on a single light in the lobby. That is the weight sitting on the business from day one. Here's something that sounds obvious until you actually run the numbers. The same building, the same design, the same room count, the same service standard can be worth wildly different amounts depending entirely on where it sits on a map. A five-star hotel in Midtown Manhattan can charge an average daily rate north of $400. The identical hotel experience in a secondary market might only command $250. That gap is not a minor detail. It is the difference between a business model that works and one that structurally cannot. There's a rule of thumb professionals in this industry actually use to test viability. For every $1,000 spent on development cost per room, the hotel needs to earn roughly $1 in average daily rate at a stabilized occupancy near 65%, just to have a fighting chance at covering its costs. Spend $1 million per room to build it, and you need to be charging close to $1,000 a night, consistently, not just on a big weekend, but as a stabilized annual average. This is exactly why almost every major luxury hotel built over the last 2 decades isn't really a standalone hotel anymore. It's part of a mixed-use project, bundled together with luxury residential condominiums or a private membership club, because developers sell those condos before the hotel even opens and use that cash to pay down debt, making the hotel portion financially survivable. The hotel, in other words, is frequently subsidized by the real estate sitting next door to it. This is also where most people's mental model completely breaks down. You picture the Four Seasons or the Ritz-Carlton owning the building their name sits on. Almost none of them do. The major hospitality brands operate hotels. They don't own the buildings underneath them. The actual real estate is typically held by a completely separate class of investor, sovereign wealth funds parking money in trophy real estate investment trusts pooling capital across dozens of properties, private equity funds looking to renovate and flip within 5 to 7 years, pension funds hunting for stable long-term yield, and wealthy family offices preserving generational wealth. These owners sign a management agreement handing the day-to-day running of the hotel over to the brand in exchange for fees, layers of them, stacked one on top of another. A base management fee, taking a slice of gross revenue, regardless of whether the hotel turned a profit that year. A royalty fee, just for the right to use the name. A marketing contribution funding the brand's global advertising and reservation systems. A loyalty program assessment on every point-driven booking. Add it together, and before a single employee is paid or a single bar of soap is purchased, the brand has already claimed somewhere close to 10 to 15% of total revenue off the top. Now let's talk about the single largest cost sitting inside the operation itself: payroll. A five-star hotel is not a building with a nice lobby. It is a live, around-the-clock service operation staffed by hundreds of specialized workers, housekeepers, engineers, chefs, concierge staff, spa therapists, revenue managers, and payroll typically consumes somewhere between 32 and 38% of total revenue, making it by far the biggest line item on the entire budget. Here's the part that surprises people once they see the math on a single department. Take housekeeping in a 200-room hotel running at 80% occupancy. That's 160 rooms to clean every day, and the brand standard for cleaning a room properly runs close to 45 minutes per room. That means you need around 15 room attendants working every single day just to keep pace. But 15 working bodies a day actually requires closer to 21 full-time employees on payroll once you account for days off, sick leave, and vacation coverage. Layer supervisors, laundry staff, and a head housekeeper on top of that, and that's one department in one hotel. Multiply that structure across every department in the building, and you get a massive, mostly fixed cost that does not shrink meaningfully when occupancy drops. A hotel room is not like a product sitting in a warehouse waiting to sell tomorrow. If tonight's room goes empty, that revenue is gone forever. And that single fact drives almost every strategic decision inside the business, including the dynamic pricing systems that constantly adjust rates in real time based on citywide events, competitor pricing, and how quickly rooms are filling relative to historical patterns. Rooms are the highest margin part of the business, but they're not actually the most interesting part of the income statement, because there's a ceiling on how many rooms exist, and every competitor in the market is chasing the same guests for them. The revenue streams that actually separate a profitable luxury hotel from a struggling one are the ones most guests barely think about. Weddings and banquets alone can generate several $100,000 from a single event, booked months in advance with a contract locking in a guaranteed headcount, giving the hotel rare certainty in an otherwise unpredictable business. Corporate meetings are even more valuable, because company travel budgets fund the bill rather than an individual wallet, making corporate groups far less price-sensitive than leisure travelers. And a well-positioned luxury hotel in the right city can pull 20 to 30% of its total revenue from conference and meeting business alone, arriving reliably midweek, exactly when leisure demand is weakest. Then there's the presidential suite, sometimes running well over $10,000 or $20,000 a night, and the honest truth about that room is that it was never really built to generate profit from room nights. It exists to anchor the hotel's reputation, to appear in every photograph and headline the property ever generates, functioning as marketing that reaches millions of people who will never personally spend that kind of money, but who will book a standard room simply because of the name attached to the building. And there's a cost almost nobody thinks about when they romanticize this business: energy. A large luxury property with a full spa, multiple restaurants, heated pools, and round-the-clock climate control can consume well over 100,000 kilowatt-hours of electricity a month. And because the pool still needs heating and the lobby still needs lighting, regardless of how full the hotel is, energy costs barely drop when occupancy does. This is exactly the mechanism financial professionals call high operating leverage, meaning your costs are mostly fixed while your revenue is not. So when demand drops during a recession, a pandemic, or a geopolitical crisis, profit doesn't just shrink proportionally, it collapses entirely, while the interest payments on hundreds of millions of dollars in construction debt keep arriving exactly on schedule, regardless of how many rooms are occupied. Here's what genuinely surprises people once they understand the full picture. Some five-star hotels were never built primarily to generate operating profit at all. Governments and sovereign wealth funds sometimes build them purely to project international prestige and attract foreign investment into a region, treating the hotel as infrastructure rather than a standalone asset expected to turn a yearly profit. Developers sometimes build a luxury hotel specifically to lift the value of everything else surrounding it, because a recognizable five-star name on the ground floor justifies charging a premium on every residential tower and retail unit next door, even while the hotel itself quietly loses money on paper. Integrated casino resorts take this even further, using luxury rooms, fine dining, and spas purely as tools to keep high-value gaming customers in the building, treating hotel losses as simply the reasonable cost of running a far more profitable casino floor. So let's put real numbers around what this actually looks like day to day. Picture a 200-room five-star hotel built for roughly $200 million, with $140 million of that financed at 7% interest, meaning close to $10 million a year in debt service before a single guest checks in. In a strong year, running at 75% occupancy, with an average nightly rate around $450. Total revenue across rooms, food, events, and spa lands around $32 million. After payroll, energy, brand fees, insurance, taxes, and a required reserve for future furniture replacement, operating income before debt service comes in around $10 million. Subtract the debt payment, and net cash in a genuinely good year lands at roughly $100,000 on a $200 million investment. Now run the weak year. Occupancy slides to 55%. The average rate softens. Revenue falls to around $22 million, but costs barely move because almost none of them are variable. And the hotel ends the year with a net operating loss, while that same $10 million interest payment is still due in full, regardless. That gap between the good year and the bad year is the entire business in miniature, not a cash machine spinning off guaranteed income, but a highly leveraged bet on sustained demand, steady pricing power, and the absence of the kind of disruption that history proves shows up roughly once a decade. The owners who actually survive this business long-term are rarely the ones who are best at running a hotel day-to-day. They're the ones who structured the capital correctly from the very beginning, and behind every perfectly made bed and every white-gloved doorman standing beneath a chandelier blazing over an empty lobby at 2 in the morning, that quiet arithmetic is the machine actually running the show.